Governor DeSantis said Florida was booming, but Fort Lauderdale was burning. Prices had doubled in just 30 months, 65,000 new residents pouring in, and the governor standing at podiums promising endless prosperity. Then, Hurricane Aaron's 160-mile-per-hour winds took aim at South Florida, and the unthinkable happened. Deals collapsed overnight. Carla Rodriguez sat in her Hollywood living room at 2 a.m., staring at the email that shattered her dream. The seller's agent had just withdrawn from the contract, citing an inability to secure insurance. Her quote, which had been $3,000 6 months earlier, now sat at $7,200. No explanation, no negotiation, just a single line. We regret to inform you. Buyer cancellations in Fort Lauderdale hit 21.3%. 1 in 5 deals gone. Panic swept through the governor's office as dreams of paradise spiraled into a financial nightmare, and the governor had no idea it was coming. For a moment, it looked like paradise had no ceiling. In the early 2020s, South Florida became the finish line for America's Great Migration. Remote workers from New York, Chicago, and California packed up for good, drawn by low taxes, year-round sun, and the promise of endless appreciation. By the end of 2024, 65,000 new residents had arrived, turning modest homes into bidding war battlegrounds. Unseen offers flooded brokers' inboxes. In Miami-Dade, nearly half of all deals closed with no physical walkthrough. Families from Atlanta and Boston wired deposits on houses they'd only seen on FaceTime. The influx wasn't just retirees chasing warmth. Young professionals, newly mobile tech workers, and investors pulled into Palm Beach and Broward, hunting for whatever was left on the market. In West Palm Beach, the median home price shot past $540,000, up 38% in just 2 years. That's enough to buy a small castle in parts of Europe. But in Florida, it barely got you a 3-bedroom ranch with a postage stamp yard. Inventory vanished. Sellers set deadlines for offers, sometimes within hours of listing. Cash buyers, many from out of state, waived inspections and appraisals, desperate to lock in deals before prices climbed higher. For locals, the new normal meant being priced out of neighborhoods they'd called home for decades. Newcomers, flushed with out-of-state equity, outbid teachers and nurses by tens of thousands. A Fort Lauderdale public school teacher watched as a hedge fund manager from Manhattan offered $60,000 over asking on a house she'd been saving for. She never stood a chance. Rental prices soared too, with 2-bedroom apartments in Fort Lauderdale averaging $2,800 a month, up 27% since 2022. By early 2025, the average time on market for a single-family home in Miami had dropped to just 19 days. In Broward, condos that once lingered for months now disappeared in less than 2 weeks. The housing boom was real, and for a brief, dazzling moment, it seemed like the only way was up. Then the buyers started running. Investors, both local and out of state, poured billions into South Florida real estate as the boom hit full stride. By January 2024, nearly 30% of all homes sold nationwide were snapped up by investors, the highest share ever recorded. In Miami, the numbers soared even higher. Redfin reported a staggering 28.5% investor share in the second quarter of 2024, outpacing every other major metro in the country. CoreLogic tracked a similar surge, with investor purchases peaking at nearly 29% of all sales in December 2023. Cash ruled the market. In West Palm Beach, almost half of all home sales in 2024 closed without financing. Miami and Fort Lauderdale followed close behind, with 38% of deals paid in cash. International buyers, especially from Latin America and Canada, joined the fray. Nearly 7 in 10 paid in full. No mortgage needed. For everyday buyers, the competition was relentless. Investors targeted entry-level homes and condos, driving up prices and outbidding locals with offers above asking and no contingencies. In the low-price tier, nearly a third of all sales went to investors, leaving first-time buyers scrambling for what was left. Governor Ron DeSantis seized on the headlines, declaring Florida the capital of American opportunity, and touting the influx of capital as proof of the state's economic strength. At a press event in Tampa, he pointed to the record job growth and home values, calling South Florida Wall Street's favorite sandbox. But beneath the surface, the speculative fire burned hotter than most realized. Blackstone, Invitation Homes, and other giants bulked up on single-family rentals, betting on endless demand. Smaller investors followed, flipping houses for quick profits or adding to short-term rental portfolios. By late 2024, investor appetite began to wane. Insurance premiums jumped, rents plateaued, and the math started to break down. Still, the legacy of the boom lingered. Miami's investor share remained the nation's highest, and the flood of speculative capital left prices elevated, even as local families found themselves priced out. For a moment, it seemed like the only limit was how fast a wire transfer could clear. 6 carriers failed. No one noticed until it was too late. Then the fine print started bleeding. 6 insurance carriers failed in Florida between 2022 and 2025, leaving hundreds of thousands of homeowners scrambling for coverage just as hurricane season approached. Private insurers, battered by mounting losses and soaring litigation costs, pulled out of the market or stopped writing new policies across entire coastal counties. In their absence, premiums climbed relentlessly. By early 2025, the average annual homeowner's insurance bill statewide hit $3,023, a 34% jump in just 2 years. For homes in Broward and Miami-Dade, the numbers ran even higher. Policies that cost $3,200 in 2021 now topped $6,000, with some renewal notices in Miami showing annual premiums of $8,000 or more. For buyers, the true price came with a second mortgage paid out to insurers, with no ceiling in sight. Lenders demanded proof of insurability before closing, and some banks simply refused to finance homes east of Interstate 95. Realtors watched deals collapse when buyers discovered their insurance quotes doubled the expected monthly payment. In one Fort Lauderdale neighborhood, a 3-bedroom ranch listed at $640,000 sat unsold for weeks after 3 separate buyers walked away over insurance sticker shock. Sellers, once flushed with bidding wars, now offered credits at closing just to keep deals alive. Condo associations, hit with blanket rate hikes and stricter underwriting, passed costs directly to residents, sometimes through special assessments topping $10,000 just to keep the lights on and the roof insured. The state-backed Citizens Property Insurance ballooned as the insurer of last resort, absorbing risk that private carriers would no longer touch. The fallout was immediate. Pending sales in the Tri-County region dropped 11% in the first quarter of 2025. Nearly 41,000 homes sat unsold, up 61% from the previous year. For households across South Florida, the dream of home ownership now carried a price tag that few could afford and no one could predict. The storm never even made landfall. Citizens Property Insurance, originally designed as Florida's insurer of last resort, now stands as the state's largest property insurer by a wide margin. By mid-2025, Citizens carried over 1.3 million policies, more than 1 in 8 homes statewide. This surge isn't just a number on a spreadsheet. It represents a massive transfer of risk from private companies to a single public backstop. Every time a private carrier pulled out of the market or went insolvent, tens of thousands of homeowners had nowhere else to turn. Citizens took them all, regardless of risk, regardless of location. The consequences ripple far beyond the policyholders themselves. Under Florida law, if Citizens can't cover its hurricane losses, it has the power to levy assessments on every property insurance customer in the state, not just its own. That means a single catastrophic storm could trigger a surcharge on every homeowner's premium, private or public, lasting years. At its current size, a $10 billion shortfall would force a 10% surcharge across the board, with no way to opt out. That's the equivalent of adding another $1,200 annually to your insurance bill, whether you live in Miami Beach or 100 miles inland. Legal exposure adds another layer of risk. Citizens now shoulders a disproportionate share of Florida's property insurance lawsuits, facing more than 20,000 active cases and budgeting over $100 million annually for legal defense. While the company covers about 16% of all Florida policies, Its litigation load far exceeds that, a byproduct of insuring the riskiest properties in the most disaster-prone zip codes. Recent reforms have slowed the tide, but the backlog remains. For Floridians, this collective exposure is invisible until it isn't. One major hurricane, 1 year of outsized claims, and the cost lands on everyone's doorstep. Citizens' property insurance wasn't just failing, it was designed to fail, and every policyholder in Florida was about to become collateral damage. But one company had been collapsing for months. August 24th, 1992. Dawn broke over Homestead with nothing left standing but splintered roof trusses and the shells of concrete block homes. Hurricane Andrew carved a path of destruction across South Miami-Dade, flattening entire neighborhoods in a matter of hours. Winds clocked at 165 miles per hour tore through 63,000 homes, leaving another 124,000 badly damaged. Mobile parks vanished, schools lost their roofs, and shopping centers became piles of twisted metal. Power lines dangled, streets filled with shattered glass, and families wandered in search of shelter. Insurance claims soared past $16 billion, bankrupting 11 carriers and leaving thousands without recourse. For weeks, the National Guard patrolled empty subdivisions while residents lined up for water and ice. Some never returned. The storm's aftermath exposed a patchwork of weak building codes and shoddy construction. Plywood nailed with staples, roofs peeled off like paper. In the months that followed, blue tarps became the new landscape, a daily reminder that safety was never guaranteed. Andrew's legacy was measured not just in lost homes, but in the scars it left on every family whose world was scattered in a single night. Maria Santos stood in her homestead driveway on August 18, 2025, staring at the weather radar on her phone. Her hands shook. She'd survived Andrew as a child, watching her childhood home reduced to rubble in 3 hours. Now, 33 years later, Erin's projected path mirrored the nightmare. She'd rebuilt, upgraded to modern standards, installed hurricane shutters and impact windows. But when her insurance renewal came back at $7,800, triple what she'd paid 2 years prior, the math stopped working. She considered selling, but listings in her neighborhood had been sitting for 45 days. No offers, no showings, just silence. Florida's modern building code, implemented in 2002, stands as the state's strongest defense against hurricane devastation. Homes built to this standard are engineered to withstand winds that once peeled roofs and shattered walls. A study from the University of Florida found that properties constructed after 2002 suffer 72% less wind damage compared to older homes. Yet, the divide is clear. More than half of South Florida's housing stock predates these rules, leaving entire neighborhoods exposed. Insurance companies recognize the difference. Premiums for post-2002 homes run thousands lower per year, and buyers gravitate toward listings labeled with code-compliant features. Dr. Brad O'Connor, chief economist for Florida Realtors, notes that buyers pay a clear premium for homes built to the modern code, sometimes as much as 10% above similar older properties. The resilience gap is more than a talking point. It's baked into every appraisal and closing statement. For sellers with pre-2002 homes, the risk is written into the fine print. As hurricane threats intensify, the market's vulnerability is measured in decades, not just dollars. The governor's office was in full meltdown. The cameras were rolling, and the governor was losing it. The storm's approach sent a shockwave through South Florida's real estate engine. On August 18th, just hours after Erin's wind field grazed the coast, pending deals began to unravel. Redfin tracked a 21.3% cancellation rate in Fort Lauderdale for July. More than 1 in 5 buyers walked away. Jacksonville and Tampa followed close behind, with nearly 20% of contracts collapsing before closing. In Broward, showings dried up overnight. Lenders froze funding on coastal properties, citing insurance moratoriums and uncertain risk. Title companies flagged files, unable to buy new coverage as insurers locked down their books. For sellers, the silence was deafening. Open houses emptied, inboxes filled with withdrawal notices, and listings that once vanished in days now lingered, unsold, uninsured, and exposed to a market in freefall. Nearly 4,000 transactions across the Tri-County region were delayed or abandoned in a single week. In Palm Beach, agents reported buyers pulling out during inspection periods, spooked by the prospect of surging premiums or discovering better insured homes on the market. The numbers told the story. Inventory in South Florida ballooned by more than 30% in July, with homes taking 40% longer to go under contract. Condo sales in Miami-Dade plummeted 17%, and single-family closings dropped 15%. In Cape Coral, where over half the homes predate the 2002 building code, buyers vanished, leaving sellers to slash prices or offer cash at closing just to keep deals alive. The psychological toll ran deeper than any spreadsheet could show. For every family who walked away, another sat paralyzed by indecision, waiting for the next forecast, the next insurance quote, the next shoe to drop. The market's momentum, once unstoppable, now stalled in the shadow of a storm that never made landfall. The only thing moving faster than the clouds offshore was the exodus of buyers running for safer ground. The same governor who promised endless prosperity now faced the collapse he ignored. Governor DeSantis faced the cameras on a sweltering August afternoon, his voice cracking as he tried to steady a market in freefall. The exodus was no longer a rumor. Census data showed 67,000 people left Miami-Dade in 2024, the county's largest outflow on record. Across the state, mortgage applications tracked a reversal not seen since the Great Recession. Outbound Floridians targeted Atlanta, Charlotte, and Dallas, driving up prices in Cobb and Gwinnett counties by 7% in a single quarter. In Nashville, agents reported a surge of cash offers from Florida, many with insurance binders attached and inspection periods waived. The governor's response grew more frantic as the numbers mounted. He proposed a $1,000 property tax rebate for homesteaded households, pitching it as urgent relief for families facing ballooning insurance bills and tumbling home values. Within hours, House Speaker Daniel Perez rebuked the plan in public, calling it a political stunt that would do nothing for renters or the uninsured, and then the speaker went public. Perez warned that checks from Tallahassee wouldn't fix the underlying cost spiral or restore confidence to a market where buyers were vanishing by the day. Behind closed doors, DeSantis' team scrambled to reframe the crisis. Talking points blamed federal inaction and global reinsurers for the insurance meltdown, but lawmakers from both parties called for real reforms rather than stopgap rebates. The administration rushed out a $1.1 billion housing and resilience package, with $590 million for retrofit grants aimed at hardening older roofs and windows before the next storm. But with a backlog of 45,000 applicants and no clear fix for the insurance bottleneck, the measures landed with a thud. In the press, DeSantis lashed out at reporters who pressed him about the spike in distressed listings and the wave of policy non-renewals. He accused the media of stoking panic, then cut off questions about the capital flight as institutional investors dumped properties at a loss. For residents like Carla Rodriguez, watching the governor's outbursts from her living room in Hollywood, the line between reassurance and reality had never felt thinner. The market's unraveling was now a political crisis, and the state's top officials were locked in open conflict as the fallout spread beyond Florida's borders. But the crisis was just beginning. By the time he spoke, the moving trucks were already gone. The investor class, once so bullish on Florida's endless upside, began a quiet retreat. Blackstone and Invitation Homes, which had gorged on single-family rentals during the boom, started offloading properties in coastal markets. Smaller investors followed, listing homes at losses just to escape rising insurance costs and falling rental yields. In Miami-Dade, investor-owned properties accounted for nearly 30% of new listings by mid-2025, a reversal from the feeding frenzy just 18 months earlier. Redfin data showed investor purchases dropping 42% year over year, the steepest decline in any major metro. Cash buyers, once the defining feature of South Florida's market, were now liquidating. International buyers from Latin America and Canada, who had propped up luxury condo sales in Brickell and Sunny Isles, pulled back sharply as currency headwinds and insurance volatility made Florida less attractive than Toronto or Medellin. Short-term rental operators faced a double squeeze. Airbnb occupancy rates dropped as tourists grew wary of hurricane season, while new municipal restrictions in Miami Beach and Fort Lauderdale limited rental days and imposed steep fines for violations. Properties that once generated $8,000 a month in rental income now sat vacant for weeks. A condo owner in Aventura, who'd purchased 3 units in 2022 as vacation rentals, watched her annual insurance premiums climb from $9,000 to $22,000 in just 2 years. Then the condo association hit her with a $10,000 special assessment for roof repairs and wind mitigation upgrades. She listed all 3 units at a combined loss of $130,000. They sold in 48 hours to a single buyer from Tennessee who planned to live in one and sell the rest. The investors knew something homeowners didn't. The math had broken, appreciation had stalled, insurance costs were eating into equity, and the risk of another storm, another round of carrier failures, another wave of special assessments made holding Florida real estate a losing bet. Wall Street's favorite sandbox had become Wall Street's exit strategy. For every day, Floridians still trapped in the market, watching institutional money flee felt like watching the last lifeboat leave the dock. If the smartest money in the room was running, what did that say about everyone left behind? The market froze. The panic didn't. In August 2025, Hurricane Aaron's 160-mile-per-hour winds forced over 21% of pending home sales in Fort Lauderdale to be canceled. South Florida's housing boom, driven by 65,000 new residents, record investor activity, and rapidly rising prices, was built on fragile ground. 6 insurance carrier failures since 2022, and average premiums exceeding $3,000 left buyers exposed even before the storm threat. Governor DeSantis' rejected $1,000 rebate proposal, combined with the outmigration of 67,000 people from Miami-Dade, marks a turning point in state policy and public confidence. Citizens Property Insurance, now holding 1.3 million policies, and the power to levy statewide surcharges, sits at the center of a system designed to absorb risk until it can't. Post-2002 building codes offer some protection, but more than half of South Florida's housing stock predates those standards, leaving entire neighborhoods vulnerable. The investor exodus, once unthinkable, is now undeniable. Miami's investor share, which topped 28.5% in 2024, has reversed sharply as institutional buyers dump properties at a loss and flee to safer markets. For families like Carla Rodriguez, still waiting for answers in Hollywood, the dream of Florida home ownership has become a waking nightmare. Insurance quotes that triple overnight, deals that collapse without warning, and a governor whose reassurances ring hollow against the tide of departures. The question isn't whether Florida's housing market will recover. It's whether the system can survive the next storm without collapsing entirely. How many more families will lose everything before the next storm hits? Subscribe so you don't miss the next shocking chapter.